Jason on today. You on the line, Jason?
I am indeed.
Hi, how are you doing?
Very good, thank you. How are you?
Good, yeah, good, thank you. Great to have you on, especially at the moment and what's been going on. I think we last had you on at the beginning of the year, and everything has changed since then. So it'd be great to get an update from you. We've got about half hour and quite a lot to go through. But do you want to just quickly kick off with a intro of the fund for viewers that don't know you?
Sure, I'll do that. And actually, I'll just give a general few thoughts rather than talk particularly to the slides. But it's interesting you said, we last spoke beginning of the year, lots have changed. And at that time, we probably were saying lots has happened in the previous 12 months.
Yeah.
Real estate in the UK has had quite a rocky road over a bit of time now, from the Brexit vote, obviously through political uncertainty, COVID. We came out of COVID obviously with feeling that things were really looking quite good and quite a bit of optimism, and a market which was functioning really well, getting back on its feet. And then this year has again been pretty difficult. What do? We invest in UK commercial property. We invest in logistics, in offices, in retail, and in some alternative or other space within real estate. So just thinking about that, we very deliberately decided we didn't want to be a focused fund. We wanted to be able to utilise the strength of Aberdeen's research, knowledge and skills and experience to be able to identify sectors and thematics which would support the objective of the company, which is to provide an attractive level of income along with the prospect for income and capital growth. And that we would then be able to utilise the real estate experience and knowledge to find assets which fit that. So we like to be able to move into different sectors at different times. We've been fairly heavily exposed to logistics for quite a long time. In fact, for over the last 10 years, we tried not to do too much buying over the last 2 or 3 years in that sector because it was quite expensive, and we were happy with what we had. In fact, we took profit in that sector not too long ago, particularly with our smaller multi-let industrial estates where we felt there was cost pressure going to impact on tenants. And so we focused on the mid-box. We invest in offices. We've actually been reducing our exposure to offices over the last 2 years. Focused very much on making sure that we've got affordable space which has great amenity, really provides a place where people want to work for our tenants. Retail, we've not invested much in retail for quite a while, which will be no surprise to anyone. Where our interest has lied is within retail warehousing. And actually that's just focused really on budget retailers, so very affordable space. Most of our rents are sort of around £10 a square foot. And again, that affordability is really important there. So we want our tenants to be able to make money. We've not bought in that sector for just over 2 years. The prices changed really quite dramatically last year and through the first half of this year, and we just felt that it got to a stage where it was hard to justify, so we didn't buy. We utilise leverage, and I do have a slide which I suppose we should go to on leverage, if that's okay, Richard. We had a facility maturing at the end of Q1 next year, and we were keen to secure an extension to that, which we've done through our existing lender, RBS. Now, I'm delighted that we've got a fantastic margin of 150 bips. We've actually already seen margins beginning to move and terms becoming harder, and a couple of banks have sort of withdrawn a bit from the market over the last few weeks. The bit which isn't so palatable is that swap rates have increased dramatically through the course of this year, and even more so over the last month. And we put this facility extension in place, I think it's about 3 weeks ago now. It's all a bit of a blur, to be honest. It's been such an incredible time. And we ended up with a very high swap rate. So on our term loan, the all-in cost of debt is just under 7%. We reduced the amount of the term loan, and our intention is that we won't be drawn on our RCF in April next year. In fact, we don't have any on our existing RCF anymore. Although the slide says 17 million here, we've sold a couple of assets and repaid that. Our leverage is just under 20%. It's low. We're very comfortable with that, and we just need to work through, this slightly higher cost of debt for the time being. And I guess, one of the comments that's been made by previous speakers is discounts. The company is on a large discount. The whole sector is on a large discount. Interestingly, well, maybe it's interesting. It is to me anyway. I started speaking to some people in the US earlier this week, just to see whether or not the pricing of UK REITs might be attractive to US investors. Could I find some additional buyers for the trust? And I realised that the discounts in the US, even for best in class, were sort of around the 50%, and their yields are actually slightly higher, sort of 8.5% to 9%. Our current yield is around 6.5% to 7%. Our discount is around the 50% as well. A level which is really painful. Obviously, we're not happy with it. It's slightly wider than our peer group, but more or less in line with a lot of real estate funds. We have done buybacks earlier this year. We'll continue to look at the opportunity, and we've just been focusing on making sure we don't need to draw RCF at the moment in debt. And quite frankly, although I think that we will begin to see some good asset purchase opportunities in the market, it's very hard to see why one would be buying an asset today when you could buy shares at a 50% discount and a similar or yield. So we'll look at that, and we'll look at repaying more debt as well. Hopefully that gives a bit of an overview. Is there anything else you'd like me to cover, or go into questions?
Yeah, just before we go into questions, I just wanted to talk on and I think there might be a question on it actually, valuations in the sector, which are obviously going to come off. Where do you see that going? I know you had a NAV announcement this week for the end of September, and you reported 4.2% valuation decline across the portfolio. Where do you see that going over the next, say, 6 months to a year?
Yeah, okay. So if I perhaps start with some context, last year we saw significant capital value growth through valuations in the order of about 22%. We saw valuation growth in the first half of this year, roughly 7.5%. And then in Q3, valuations declined. Most of that decline came through in industrial and logistics. Really two reasons for that. One, it was a very low yielding sector, and this valuation movement has really been driven by debt costs, and the primer properties with the lowest yields had the most significant outward yield shift immediately. But also it's the most liquid sector, so valuers were able to see more evidence. And valuation in the UK is done on a comparable evidence basis. There is generally a valuation lag. So because it's a point of inflection, we actually announced that the level of our valuation fall, I think the 4.2%, as soon as we got the valuations in, rather than waiting until the NAV, which was this week. As I say, 4.2%, is at the end of it? No, absolutely not. We anticipate values falling over the next, probably the next 12 months. We're seeing a global re-rating of real assets, and we're not going to be immune to that. I think we're in a relatively good position, and I think it's always very difficult to talk about, we're performing well relative to others when it's negative. It's never a nice experience. But our portfolio generally has slightly more yield on it, and so we've got a little bit of sort of cushioning, I think, from this repricing, which is driven by gilts moving out, risk-free rate moving out, etc.
Yeah. Got quite a few questions come through on the debt, which
I expected that.
Probably expecting, yeah. So, what is the average debt tenure? So it's 3 years. Did you miss the boat in locking low rates?
Yes. Well,
yeah.
we benefited from having very low rates for a very long time. And with hindsight, I rather wish I'd locked in at the beginning of this year. Do you know, three years ago, when I was listing what I thought my biggest risks were in the fund, I'd put debt refinance at higher interest rates. And then when we went through COVID, I removed that. The speed of change in circumstance has been quite incredible. We started looking at the refinance earlier in the year, and yes, with hindsight, I'd love to have done it earlier.
Yeah. And then with the couple of questions here on the dividend, so with the increase in cost base, are you going to be able to maintain your dividend?
So what I'm not going to do is give a dividend forecast. I can't. It's the board's decision apart from anything else. But my expectation is yes. And why do I say that? Obviously, we know we're going to see an increase in cost of debt, which is going to have an impact on dividend cover. But we've also got some great things happening. On the letting side, we've agreed terms when we're just refurbishing a unit, a logistics unit at a great rent. So that'll come on stream into next year when the new debt cost starts. We're developing a pre-let unit again that comes on stream early next year. We've got actually more of our vacancy, our office vacancy, under offer today than at any time over the last 3 years. And I have my fingers and toes crossed, and I'm touching wood when I say that, because it's obviously, you know, no guarantee that they go through. But all of these things can lead to some fairly significant growth in our rental quite quickly. We have about £6 million worth of reversion in the portfolio. And if we can reduce our voids in line with the space under offer, the deals we've already done, some rent reviews coming through, and these pre-let developments, then that's really going to mitigate the impact quite a bit.
So just on that, what is the what's the impact on your ERVs, the estimated rental value, in your latest sort of now?
The impact of
what in valuations, have they come out or come in?
Yeah, so the ERVs haven't really moved much this quarter. There hasn't really been evidence of change, and we're not seeing it particularly in the deals we're doing. So I think rental values are likely to be maintained and perhaps increase in logistics still. I know that may feel counterintuitive in what we're expecting to be a recessionary environment, but actually there's very, very low levels of supply of logistics. We've got great units, and also the change in supply chain management, I think, is going to be a continued driver of demand as more and more companies struggle with supply chain management from overseas and look to increase either production or storage within the UK. So I think that market actually still will see some rental growth, and we're not seeing any slow up there. On the office side, we haven't yet seen much change, but I think there will be pressure on rents undoubtedly. Now we're positioned in assets which I think are quite affordable, and one of the things we've done is focused a lot on providing fully fitted space which is ready for tenants to move in, so they don't need to worry about capex for fit outs, etc. And we found a certain resilience and higher level of take up because of that. And retail, actually, I've got no reversionary expectations within retail in the portfolio. I just don't see rents growing there, and in fact anything coming back. But we haven't got any vacancy, and we don't have any lease expiries in the near future.